Welcome to the Daily Update, where I'll go over the action in the market for Thursday, June 22nd, and then we'll see how things look for Friday, June 23rd. Please be aware that I'm trying some different things with the audio. I'm just trying to do a lot of experimenting to see what ends up working out the best. Talking about Thursday, I wish I could say that the market is no longer at a tipping point, but it still is. We had the mega caps do really well, and that helped the S&P, but we had the Dow that was flat. We had the mid caps and the small caps that were down. You can see that there's a real indecisiveness right now as people don't really know what side to commit to at this point. There's a lot of positive things to dwell on. There's still some overbought indications, and there's some negative things to dwell on as well. We'll go through the charts, come to our conclusion, and then see where do we go from here. Before I get started, please know that I have a supplemental video that talks about hedging or how you can protect either a stock that you own or a portfolio that you have. I'm also considering adding a new monthly video on the economy. Now, if I do start that will probably be at the end of July, not the end of June, because it takes a long time to put all this stuff together and get it organized. But I'm trying to keep things up to date as to are we going into a recession or are we not? That's been really long in developing right now. That's the main motivation for even doing this in the first place. I do have a PDF where you can download the slides and charts to follow along. I have a private Facebook group that you're welcome to join. There is a new poll that is posted, and I'll be going over the results this weekend. And then I'm really trying to keep a close eye on the YouTube comments to make sure that they're relevant. I don't get a lot of comments on this channel, and that's just fine. The comments that I do get, I want them to be personal, applicable, and beneficial to everybody who reads them. And I also post these same videos on Rumble, and here is the channel. All right, let's go back and talk about what happened. At the open, we had a gap lower open. We went down to S1 at 43.55. Prices then rebounded back up to the daily pivot at 43.71. As the day went on, we chopped between the daily pivot and the unchanged level, and then later in the day, we saw some buying coming in. It took prices higher, back up to R1, and then we closed at R1 at 43.81. That ended up being the high for the day. We were up 0.37%, but volume still remains below average. You have a lot of folks that are kind of apprehensive right now. The technicals were still positive, but there are some negative things. There are some things where we're working off this overbought situation, and there are some negative things that we need to be aware of. And inflation and interest rates are still what's really driving the market. What are some comments that we can make? The Bank of England, the Norges Bank, the Swiss National Bank, and the Central Bank of Turkey all raised rates on Thursday. If you think we have bad inflation in the U.S., you ought to go to Turkey. Man, it's at 15% right now. Rate hikes also produce some concerns about global inflation. And then as these interest rates come in and take effect, not only in the U.S., but globally, this has a real tendency to slow down the economy, which is what they're designed to do, and that could have an impact on global growth. Fed Governor Michelle Bowman, at the scheduled speech that she was supposed to say, said that additional policy rate increases will be necessary to bring inflation down. Not anything that we hadn't heard before, but just to hear it again just kind of spooks the market a little bit. Fed Chair Powell had his second day of testimony before the Senate Banking Committee. Really didn't give anything new. There was nothing really that was surprising. Yet there was some consternation or arguing going back and forth regarding capital requirements for banks. That ended up having a toll on the bank sector and the financial sector. The indexes ended up closing mixed. Mega cap growth, that was really weak on Wednesday. Well, it came roaring back on Thursday and outperformed. On a short-term basis, we still have the short-term ADX study. Now, please bear in mind, that's an experimental chart that I'm using. Our stochastics are starting to wear off some of this extreme positive reading, but not quite there yet. And some of our oscillators, especially the slope oscillator, which is our touchiest oscillator that we use, is still looking kind of extreme, but starting to roll over slightly. Intermediate term, we have the Sean trend meter, the PMO, which is looking a little toppy. There are some parts of the PMO study that are also extreme positive. We're keeping an eye on our oscillators. And then the TTM squeeze is starting to come down slightly, but is still extreme positive. The dollar was up and interest rates were also up, and that gave some headwinds to stocks overall. We still have all of the yield curves that remain inverted. And sentiment is still extreme positive. With the slight update with the S&P, we ticked up from 78 to 80. Our trend is still positive. The green line's still coming down, even with the update. It's going to take more upward movement to turn that green line back up. But the ADX itself, it's above its moving average, and both of them are above 20. I've kept our bias at negative right now just because we saw a real mix across the different indexes. You could switch that to positive. Please keep in mind that the only subjective parts of these videos are when I come up with the bias and the momentum. I try to let all of the other charts do the talking for us, but this is where I try to come to some kind of a conclusion myself. So please take that with a grain of salt. The economic reports that came out, we had the first quarter current account balance. It came in at negative $219.3 billion, more than the $216.2 billion that we saw last time. And this is not a real big market mover, but it does have an impact on the U.S. economy. Weekly jobless claims, even though they were unchanged, they're still very high overall. And I'll have the chart to show you where continuing jobless claims have declined just slightly to 1.759 million. And I have a chart. Existing home sales, they were up 0.2% on a month-over-month basis. When you project that out annually, it comes in at 4.3 million, a little bit more than the 4.28 million that they had expected. Last time it came in at 4.29 million. When you look at sales from a year ago, we're down 20.4%. The leading indicators, and this is one area that I've been really keeping an eye on, they were down 0.7%. A little bit less than the down 0.8% that they expected, but more than the down 0.6% that we saw last time. I have a chart to show you of that. Going through some charts from the Isabel Net blog. This is a variation of a chart I talked about yesterday, the truck tonnage index, and then we have the S&P 500, which is the purple line, and at the time this chart was created, we were going up, and we're seeing a little bit of a turn up in the truck tonnage index. Now, this is on a monthly basis, where the chart that I showed yesterday is an annual year-over-year change. So that was actually showing a decline where we're seeing a bit of an advance when we look at this chart. So this could suggest that we're seeing a little bit of strength still in the economy. Then here's a technical analysis chart looking at the weekly version of the S&P 500. Not a lot really different here than what I go through. The main thing that I keep an eye on is, are we above this green moving average? As long as we're above that, the long-term secular bull market still remains intact. They also have some other areas of resistance if we start to go up and support if we continue to go down. Then this is kind of interesting, but the real takeaway from this is the valuations compared to where they're at right now, and then based on what have they been historically. Currently, we have a forward PE ratio of 19.3. Historically, it's been down around 18, so we're a little bit expensive there. And you can look at some of these other measurements and see where they're coming at. Some don't really give you anything from a historical basis. Here's real investment advice, just trying to put sentiment together with a chart of the S&P, where at the time this was generated, we were still going up with the S&P overall, and we're seeing sentiment really start to improve as well. And we're seeing that in some of our other charts. Then we look at the dollar, and it's near its March 2020 high, and this could be bullish for inflation assets. Typically, a weaker dollar is also more beneficial for stocks, where we had come up, come back down, and now what had been resistance before is now becoming support. We're wondering if this level will be able to hold. The rolling 4-week average of flows have been positive. That's the dark blue areas now where more money is going into the market. And then we look at the cumulative fund flows across assets. Most are still going into money markets, followed by government bonds. And then we have stocks, and at the bottom are corporate bonds. What's the exposure to bonds? We've seen that drop off a little bit as bonds have been coming under a bit of pressure. And then what's the current activity indicator? And then comparing that with GDP on a global scale, where the dark blue line is the current activity. And then this is the historical GDP. And then when they take it out a little bit, this was for the fourth quarter of 2022. And then what is the estimate going to be going forward? And this suggests that we're seeing a little bit of weakness in GDP, but it is recovering. Some Twitter charts I ran across. This is not necessarily a real relevant chart, but it's kind of interesting and it's what people like to talk about. Somebody from Fidelity pointed out, is this a bear rally or a new bull? Bear market rallies generally do not retrace more than half of their preceding declines. The S&P, which is a cap-weighted index, and that's what we follow, and then we compare that to the equal weight index, it's retraced 64% of the 2022 decline. This has exceeded all previous bear market rallies going back to the 1920s. And then he says, technically, from a purely historical perspective, it's getting more difficult to call this a bear market rally. From a technical definition, we have now assumed into a new bull market. Again, you're splitting hairs here, either, tomato, but it's just kind of something interesting just to give you a sense of where we're at. Game of Trades had an interesting couple of posts here. This is from sentimenttrader.com, which is a phenomenal website. It just says that there's a real high confidence of dumb money right now. That would be you and me because we're individual investors. And a lot of times when we get to a pretty extreme reading, that has marked some kind of a top in the S&P. And then another chart shows the LEI or the leading indicators. And then he shifts it forward by 12 months. And sometimes that works, sometimes it doesn't. But it's just showing where the 10-year Treasury yield minus the Fed funds rate is starting to decline. And then the yearly change in LEI is turning back up just slightly. But overall, we would expect both of these to go down. Then I have another chart to show you in a moment. The weekly jobless claims, they have remained unchanged now for the third week in a row, but they're still high overall, so our average continues to advance. But the continuing claims are still headed more in a downward direction. And then when we take the initial jobless claims, which is in red, they're still at the higher level that they've been at. The blue line are the continuing claims, and they're declining. And then a few weeks back, we had the unemployment report, just to kind of put all of these on the same chart. This is the LEI chart that I found where LEI remained negative, continuing to signal weakening growth prospects. The year-over-year change in the LEI is the blue, and then the change in real GDP is also showing a decline, but we're still positive. This suggests that we may hit into a recession, but we can get a lot of evidence together that says we're not going to go into a recession, and that's why the debate continues to go back and forth. Looking at our charts and analysis, here's the 10-minute intraday chart of the S&P. We did gap lower down to S1, where we were able to bounce back up to the daily pivot. And then after that, we just chopped around between the daily pivot and the unchanged level. Finally, later in the day, we were able to break above the daily pivot, get up to R1, fell back a little bit, and then closed at R1, which was the high for the session. So that in and of itself is positive. The S&P is hanging in there, but it's mainly due to the mega cap stocks. Here's the intraday chart. We were pretty much flat in the initial overnight session. Then we saw some weakness as things were going on in Europe and they were adjusting interest rates. But then after we did open, we saw a bit of a recovery. We were able to get above the unchanged level and then seeing the strength going into the close. And then we are seeing a little bit of strength in the initial overnight session. However, right before I started to record, I looked at the futures and they were down about 0.5%. But this is many hours before the market opens and that can change quite a bit. This is also kind of encouraging where large cap growth did outperform large cap value. Value was down on the day where growth ended up being positive. On a closing basis, growth was up 0.77% where value was down. Growth was down for the mid caps, but it was down less, and it was down less for the small caps. So when we look at our ratio between growth and value, this is pretty encouraging right here, where growth really outperformed value in Thursday's session. Looking at sentiment, still suggesting that there's not a lot of fear, even though we turned up slightly with the Ulcer Index. And there wasn't this big movement in the VIX like I thought there might be because they're switching futures contracts. It did decline on the line chart as well as on the bar chart. And the VIX of the VIX also is pretty much even right now. Volatility is falling off slightly. Equity put call ratio is declining just slightly, but we're not really working off of a signal. As we continue to go up, usually what happens is the equity put call ratio will go down. Longer term though, this is more positive. We're still seeing the 253-day simple moving average continue to fall. You have to look at this in an inverse type of reasoning. When this was going up, that's when the market was having trouble in 2022. Now that it's turning and going down, that could be longer term positive. Then we look at the VIX to move ratio, where we dropped off a little bit, showing that fear, both within bonds and in stocks is still very, very low. The VVIX, or the VIX of the VIX, in a ratio to the VIX itself, where it's been going up, our chart shows that it's been going down. It just depends on what perspective you take. Then looking at the ratio, again, it's showing that the VIX to the VVIX is declining, and with the 50-period moving average, it's also going down. When we look at the MOVE index, it ticked up just a little bit because bonds were down, where the VIX, which measures volatility of stocks, it did decline, and the relationship was not as strong as it has been in the past, as we're seeing a little bit of adjustment happening. This fear gauge ticked up just slightly, but is still in an overall downtrend, as well as the other fear gauge that we look at. Folks are still favoring a risk-on posture, even though this ratio did decline slightly. Our advanced decline line, we are still showing a decline based on price and volume after we had been seeing a real improvement. Now, this suggests that there's still a little bit more weakness going on in the S&P. To have an up day, but to see the advanced decline line actually go down is a bit of a negative. We're also seeing our 5 periods starting to roll over when we look at the new highs. As we did go up, we didn't see a real breakout in new highs. We're seeing new lows start to expand just a little bit here. So we'll be keeping an eye on this overall. With our 10 period, we are pretty much flat to slightly declining. The advanced decline ratio still above 0, but also declined. Accumulation distribution did turn up and is above the moving average. That's positive. But when we look at the cumulative advanced decline line for the NYSE, we're starting to see more weakness. And we're also seeing some weakness with the regular advanced decline line, but we're still above this upward sloping trend line. If we see further weakness, we may drop below that. When we look at common stock, we're still seeing some more weakness based on price and volume, where we had been seeing some more improvement. Then our broad range of the NYSE, we're dropping below the moving average. We're coming down slightly with the S&P. We're dropping below the moving average with the mid caps as well as the small caps. Keeping an eye on our trend, where the green line is on top, but it's declining. The ADX is rolling over just a little bit, but is still above the moving average. Our shorter term ADX is also rolling over a bit, and the green line, even though it's on top and had been extreme, continues to decline. Volume continues to drop off. And on a short-term basis, here is a chart showing that we're still above the previous high set back in August of 2022. And then on the bottom, you see where volume is declining. The 20-period moving average is no longer extreme positive, but now it's headed lower. The 50-period is turned down, as well as the 200. Keeping an eye on our double and triple exponential moving average, we are dropping below both moving averages now, even though we had an up day. Keeping an eye on our regular 20-period simple and exponential moving averages, we're still well above both. If we continue to fall, we may be looking at this for support. However, I'm bringing up a rainbow chart because we're coming down to the 10-day moving average. That could be more positive because that's a shorter-term moving average. If we come down to that level and then bounce up off of that, that does suggest more that this is a pullback. But if we continue to fall below it, we could go down to the 20, bounce up off of that. That would still suggest just a pullback. If we break the 20, then it might mean that things are turning more negative. Our stochastics chart in the short term, coming down after being extreme, as well as intermediate term. We're still extreme in the long term, but we are turning down. The force index ticked up slightly and is above 0. And then our intermediate charts, we're ticking up just slightly with the balance of power. That's positive. We're right at the 50-period moving average. When we look at our double and triple exponential moving averages, can this provide some kind of support? These moving averages move a lot quicker than our standard moving averages. Will we be able to get a bounce up off of this, or are we going to fall down below that? The go-no-go system still remains more neutral with the lighter blue bars. The TTM squeeze, after being extreme positive, is now starting to turn back down, and the bars are going from a lighter color to a darker color, so that's positive with a negative bias. Longer term, also starting to come back down with the TTM squeeze. We're also back down into the second standard deviation right now, still suggesting that we might have some more room to fall, but this is still maintaining more of a positive stance. The PPO study still is positive in the long and intermediate term. We're still positive in the short term, but we are declining. The Erin indicator ticked down just slightly after giving us an extreme positive reading. The McClellan oscillator based on the S&P 500 has now dropped below 0. And the NYSE McClellan oscillator has also gone below zero. That's more negative. So when we look at our summation index based on price, we're starting to turn over. Based on volume, we have already turned over. And as I like to point out, this sometimes can be a leading indicator of what is happening. When we were turning up a few weeks ago, it was volume that was really leading the turn up. Now that volume is turning back down, will that lead price lower going forward? The summation index for the NYSE ticked up just slightly based on price as well as volume. The Swenlin trading oscillator did decline based on price and volume. They're still above zero, but they are declining. And we're just a little bit below zero now based on volume. The PMO still starting to roll over as we get above this red line. We're still positive based on price and volume, but we're seeing both of these roll over. The PMOs that are rising are no longer extreme positive. Now it is declining. We're turning down with the number of buy signals after being extreme, and we're pretty much flat with the PMOs that are above zero. The Elder Impulse system for the S&P remains neutral. The parabolic SAR, this is more negative. We have two dots now that are on top. We could always switch back, but if we see more weakness, the dots are going to remain on top, and that could suggest that things are turning more negative. The slope is still positive, and we're rolling over after going above this green line. The MACD is also rolling over, but still remains positive. We're seeing some of our oscillators starting to roll over after giving us extreme readings. However, the longer-term oscillators are continuing to be positive. We're watching the tricks go above this line, and the KST is also getting above this line. Now, I put these lines on here. They're more arbitrary, but they just give us some kind of guidepost to know when we've gone either up or down too far too fast. The Sean trend meter, it's ticked back up slightly and is extreme positive, but not extreme positive. The BPI is hanging in there a little bit. Even though we declined, we're not really seeing a real decline in this yet. The NYSE bullish percent index did turn down but remains above 50. The Chaikin money flow did see a bit of a positive bounce, where the Chaikin oscillator ticked up just slightly and remains above zero. The money flow also turned down just slightly but is above 50. Ultimate oscillator is declining but is also above 50. The vortex also declined, but the green line is way on top. On balance volume ticked up slightly and we're above the moving average. We're still seeing a little bit more weakness after we had been seeing an improvement with the stocks in the S&P above their 200-day simple moving average. We're starting to see a little bit more weakness and dropping back down below this breakout with the 50-period moving average steady. And here's another look at that same chart where it's color-coded with a histogram. The Copic curve rolling over but still is positive. Pring bottom fisher, still generating a buy signal. Looking at our Fibonacci and line studies, not really deciding too much right now based on this chart. We did come up to this resistance level. We've been falling back from that level. Are we going to be able to go up and break through this resistance, or are we going to continue to fall? Short-term Fib levels, we're still above the 100% retracement, and that goes back to the August 2022 high. If we keep falling, we'll be watching the 43.25 level. Longer term, we're above this 61.8% retracement level at the 43.13 level. And then if we really start to fall, we'll be watching the 42.14 level. Our different charts still looking a little more negative with the Heikin Ashi, where we have the dark candles. The Kegi is still positive but pointing down. The Renko chart still looks positive, and the 3-line break is also still positive. Our different indexes, the equal weight index did underperform the S&P, and it's continuing to underperform overall. And we saw a bit of a tick up in this ratio where the big stocks were outperforming the smaller stocks. We're still seeing a little bit of improvement with the transports. We had been really watching this negative divergence between the Dow and the transports, but they're turning up, and under the surface there appears to be some strength. When we look at the utilities on a shorter term basis, we are seeing some negative divergences. The transports are showing some improvement but continue to underperform the Dow. Looking at discretionary and staples with our equal weight studies, came down just slightly with the discretionary. The staples did show a little bit of improvement, so our ratio, even though it's going up overall, did decline in Thursday's session. The Dow is still maintaining this support level above R1, and the diamonds still remain neutral. The NASDAQ, after coming up almost to this R2 level, came back down to R1 and now could be starting to bounce back up. And the NASDAQ fib chart shows that we came up to this 61.8% retracement level, fell back. Are we going to be able to come back and give this another try? Looking at the NASDAQ new highs, new lows, we're turning up just slightly, but our indicator has now fallen below zero. And overall, we're seeing a real negative divergence with this. The NASDAQ 100 coming up to the previous high, falling back, came down to the R1 level, bounced back more. Are we going to be able to break through this, or is this overhead resistance going to cause a problem? The Elder Impulse system for the Qs remains neutral. We're still above the 61.8% retracement level with the NASDAQ 100. The NASDAQ 100 BPI continues to decline, so that's a negative divergence. But the Qs are really outperforming the Dow overall, and their relationship still remains very, very strong. The small caps finally broke down below support. That's negative number one. But on the positive side, we're still above the 200-day simple moving average. Here's another look at the small cap index where we did break down below this level. We were not able to get through resistance. We're not down to the 200-day moving average yet, but on the previous chart, we're getting a little bit closer to that. When we look at the RSI, it's coming right down to 50 and declining, and the MACD is also starting to turn more negative. The Elder Impulse system for the small caps is now switched to negative, and the small caps really are underperforming the S&P 500. The small cap growth to value ratio did show some improvement. So again, we're seeing a little bit of strength under the surface, and this ratio remains in an overall uptrend. The mid caps fell a little bit below this R2 level after giving us a recent golden cross. However, for the Elder Impulse system, the mid-caps remain neutral. But when we look at growth versus value, we're seeing more strength. It bounced up in Thursday's session and remains in an overall uptrend. The home builders ticked down just slightly with the ETF, so the ratio ticked down just a little bit. The correlation between the two is starting to get stronger again. The FANG index was up almost 1.5%. If we keep going up, are we going to bump into this previous high at about 8,000? When we look at the broad range, though, comparing stocks with shorter-term bonds, we're still showing that stocks are outperforming. Another broad market look with further out bonds also shows that stocks are outperforming. The tech sector continues to outperform bonds. And the S&P is continuing to outperform bonds, suggesting that the stock market thinks we might head to a soft landing. Home construction continues to go up. Again, as I say every time I show this chart, there's some smart people who know what this industry is all about. If we were getting ready to fall off a cliff, would this ratio be going up? Probably not. Growth saw a little bit of improvement when compared to value. And then looking at the U.S. 10-year yield, subtracting the German 10-year yield, that gives us this line where we tick down just slightly, and then we compare that to the dollar index. And it shows that there's a very strong correlation between the two. And then on a weekly basis, we look at the weekly S&P 500 and we compare that with the German DAX. It's amazing that there is such a strong correlation between the two. So if you want to look outside of the US to see either confirmation or a negative divergence, keep an eye on the German DAX index. They are the biggest and strongest economy within the EU. Keeping an eye on the financial sector, we're down 0.78% and remain in a downtrend. We're still maintaining price above this support level, but the financials continue to underperform the S&P, and the regional banking ETF is really underperforming the financial sector. Bonds, we show where yields were up and price was down. And the correlation longer term is showing a little bit of improvement where we're turning down just slightly with the shorter term relationship, and the spread between the two remains really wide. When we look at the value to growth ratio and compare it with the 10-year treasury yield, they're going kind of in opposite directions right now, where the yield went up, the ratio went down, but the correlated relationship still remains very strong. Folks are still tending to prefer riskier bonds over more conservative bonds. This is a concern, though. We're seeing this ratio going back up when we compare cash to 3 to 7 year bonds. When there's more certainty about what's going to happen economically and with interest rates, this ratio would be going down. And in fact, it is going up. And we're also keeping an eye on this. We're still above the 3-month yield going back to the high set back in 2007, which is right before we saw the whole financial crisis. So we're wondering if this is giving us some kind of a warning signal. Our long-term analysis, this is looking more positive. On a daily chart, the special K is going more above the red line. But I brought up the weekly chart to show where we're falling down below the red line, so we're seeing a bit of a contradiction here. An update of our possible positive scenarios, we are declining slightly but still positive based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. The Qs are outperforming the S&P, discretionary is outperforming the S&P, and large cap growth is outperforming large cap value. With the large caps, we're still seeing an improvement. The mid caps, a bit of an improvement, and also a bit of improvement with the small caps. The S&P to utilities ratio is continuing to go up overall, which could give some good support to the S&P. When we look at the broad range of the 5-period moving average of the highs minus the lows, even though we're declining, we're still above zero. The 10-day average of the highs minus the lows in the S&P is still extreme positive. As I usually point out, we can look at this chart two ways. We're getting an extreme positive reading, might suggest that we'll see a pullback, or if we can stay up in this area for a while, that would suggest that there's good solid momentum. We're still going higher with our 50-period exponential moving average of the new highs minus the new lows, and our indicator, even though it's dropping, is still above zero. We're seeing a little bit of improvement when we look at S&P growth versus value. We're still in an overall uptrend, but it had been falling off. It would really help the S&P's cause if this ratio were to continue to go up. And we're turning back up slightly with the staples, the S&P 500 ratio, but we have been declining overall. We'll have to see, can that give some good support to the S&P? So what's our outlook for Friday? The technicals are still positive, but we remain at that tipping point. I wish I didn't have to be so indecisive, but the market is really indecisive right now. We do have the preliminary IHS Markit Manufacturing PMI coming out, not a real big influential report. And we have the whole list of geopolitical events with inflation and interest rates being the main concern for the markets. Here's the updated version of the economic calendar for the week. We've concluded all of the scheduled speeches for members of the Fed. Now, if we hear anything from them, it may be at an interview or some kind of an article or something that was not necessarily scheduled. Looking at the Stock Traders Almanac statistics for June 23rd, we tend to be pretty negative with the Dow, where we're neutral to negative with the S&P and NASDAQ. And then we look at this over a period of time. Remember, June was pretty strong, and then we come into a period of weakness. Well, we're in that weakness period right now, and then as we get a couple days further out, that's when we see some strength going into the latter part of the month. Now, this is just historical. Doesn't mean we have to follow this pattern, but so far in June, we have been pretty close to that. And then also looking at the NASDAQ on a historical basis, it tends to remain fairly strong going into the middle of July. So our scenarios, can't really go with the down one right now unless you're completely convinced that we're going to start heading lower. Hard to go with the up one because we're still at that tipping point. There's some positive signs, there's some negative signs, there's some overbought indications, and there's a real indecisiveness within the market right now. But we can't really go with the sideways either because our ADX is showing that we have a strong trend, even though the green line continues to decline. So our warning signs, the parabolic SAR is negative. The BPIs are still continuing to diverge. The S&P BPI is still hanging in there, even though it's declining slightly. The VIX is showing that there's a lot of complacency, just no fear right now. The new highs, new lows on a cumulative basis for the NASDAQ are still showing weakness. The 3-month yield is still above that 2007 level. The small caps did give us a recent death cross, and it just fell through support. Earnings season, and I don't know whether to say it's over or not. It's either positive or negative depending on how the company reports. Positive signs, the seasonality and the setups, those are still there, and I went over them in the weekly video. The long-term special K indicator has switched positive on the daily chart, but it's crossing over negative on the weekly chart. The longer-term equity put-call ratio is turning more positive. It means we're going down. We have to look at that chart in an inverse kind of way. The Copic curve, even though it's showing some weakness, is still generating a buy signal, as is the Pring bottom fisher. The S&P is still above the downtrend channel upper line. I haven't been showing that chart, but we're still well above it. We're still in a risk-on posture. Lower price levels may provide support. It might be a moving average. It could be a fib level. It could be a previous high. It could also come from another index. And the S&P continues to outperform utilities. The NASDAQ and NASDAQ 100, they're continuing to break out. They had a pretty good day on Thursday, but there is this overhead resistance above where we're at right now. And then the staples to S&P 500 ratio overall continues to decline. The mid-caps also generated a recent golden cross where we're seeing more weakness with the small caps. And small and mid-cap growth does remain positive overall, especially mid-cap growth. So our conclusion, the S&P it's positive, but it remains at a tipping point. In the short term, it's more mixed right now, and we're slightly overbought with some of our indicators. Intermediate term, we're positive and continuing to pull back from being overbought, but we're still positive in the longer term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.